JPX energy market weekly updates. In this week's video, let's take a look at the natural gas market. As most gas supply in Europe is now priced with reference to hub traded prices, with TTF far and away the most traded hub, the EU's energy ministers agreed December 19th to implement a new gas market correction mechanism, or commonly known as a price cap, that imposes a TTF price ceiling of €180 per megawatt-hour for a year from February 15, 2023. Because natural gas market is still a seller's market with less supply and more demand, it has increasingly become a global commodity that is traded between regions as a form of LNG. Because natural gas market is still a seller's market with less supply and more demand, it has increasingly become a global commodity that is traded between regions as a form of LNG. Because LNG prices better reflect the gas price developments at a global level, the proposed regulation also clarifies how the LNG reference price will be calculated. The reference price is a daily average of number of price assessments comprising the following price assessment. The correction mechanism will be automatically activated if the market sees two conditions met. The TTF month ahead price exceeds €180 per megawatt-hour for 3 working days and is €35 higher than the reference price for LNG in global markets for the same 3 working days. The front-month TTF London close versus the average of plus JKM and Northwest Europe LNG price assessments shows that about 14 of pricing days in 2022 would have fallen within the scope of the correction mechanism according to an analysis by Standard & Poor's Global. The vast majority of these include the period from July 26th to September 27th, when Europe intensified efforts to fill its gas storage capacity by targeted date in November. The problem with the price cap is that it addresses the symptom rather than the cause. The massive supply shock to both the European and global LNG market caused by the reduction in Russian gas flows. Secondly, we could see a shift in focus to over-the-counter market, as the EU price cap is primarily designed for the future market. It will make exchange future contracts illiquid, and we could see large gaps in pricing between OTC and exchange markets. IC has warned that price cap on front-month TTF gas futures could trigger widespread market distortion and risk to the viability of the TTF gas markets. Since Russia slashed pipeline gas supply from Russia to Europe, the EU and Asia have competed for LNG cargoes, with prices setting record highs on both markets earlier this year amid intense competition and supply-side issues. The EU has managed to outbid Asia this year because of high prices in Europe and lower demand in Asia, including in China. Massive LNG imports had helped Europe's gas storage levels cross the 90% mark before the start of winter. The EU's gas price might not have an impact on the bloc's current winter demand, but could impact its procurement to fuel inventories for the 2023 to 2024 winter, where gas and power markets may be even tighter in 2023 as the region faces its first year without significant volumes of Russian pipeline gas and rising Asia demand. Among Asian LNG suppliers that actively sold LNG cargoes to Europe this year, some importers may opt to sell their LNG, which was originally planned to be sold to Europe locally or to other markets next year, should the global LNG price rise above the EU gas price cap, which will in turn lead to less supply in Europe and raise the LNG price in Europe again. On the other hand, a lack of new liquefaction facilities coming online globally stands to constrain supply growth, despite persistent high prices next year. The result will be global gas markets forced to balance on demand destruction and existing stocks instead of LNG supply growth. Extreme volatility in the global LNG market in 2023 is likely to continue. While JKM is the Northeast Asian Spot Price Index for LNG delivered extra to Japan and Korea assessed by Platts, the price reflects not only the cargo delivered to Japan and Korea, but also the cargo delivered to China as well. Rising liquidity for the JKM indicators has supported the movement to start using it as a benchmark in both spot and long-term contract pricing. Similar to the OTC swap contract, JPX LNG future contract is a cash-settled contract which uses the average of assessed plus JKM prices during the period from the 16th of the 2 months prior to the contract month to the 15th of the prior month to the contract month as the final settlement price. The JPX LNG future contract provides a more convenient hedging method for the majority of investors compared with other derivatives. For more details about the contract, please refer to the official JPX website. Okay, that's all we have for this week. Welcome back next week.